Hello, everyone, and welcome back to the afternoon session on the geopolitics of energy transformation, where we're looking at the topic from different angles. We previously looked at the drivers of geopolitics with Keisuke-san from the IEA. And this session, we're going to focus on solely on oil markets and the different drivers and fundamentals that are shaping the outlook for oil markets. The title of this session, as in the program in front of you, is When Will the Oil Markets Bounce Back? But actually, if you look at prices since December 2020, and actually even today, you have the impression that that's it, we're out of the woods and we are facing a very strong oil price rally. But how sustainable that recovery is, bearing in mind the massive production cuts that OPEC Plus has adopted to support this growth in prices. This session will run over 60 minutes, and we're going to have 20 minutes for Q&A, but don't wait for the Q&A time. Just send us your questions and I'll pick them up throughout, and especially during the last 20 minutes of the discussion. We're going to touch on key issues such as the lessons that we learned from previous economic crises, and how the slump in oil price that we saw in 2020, the drastic decline, especially if you think of April 2020, how does it compare with previous events? What effect did it have, and it might continue to have, on the global economy and the economies of major producing countries? Who has been hit the hardest, and what kind of dynamics we should expect to see between major producers as they fight for market share? So these are some of the questions that my distinguished speakers are going to address, and let me introduce them very quickly before we start the discussion straight away. I have Giovanni Serio, who's a global head of market analysis at Vitol, and he previously worked with companies such as Noble, BP, Goldman Sachs, and Italy's central bank. Dr. Leila Benali, former chief economist and head of strategy at APICORP, and previously with Saudi Aramco and IHS. And in December 2019, Leila was appointed by the King of Morocco as a member of the country's new development model committee. We have Professor Meghan O'Sullivan, who is a professor of the practice of international affairs at Harvard University's Kennedy School of Government, and she has published extensively, including several books on the geopolitics of energy, and she is also a former diplomat who has served as special assistant to President George W. Bush, among many other roles she played. We have Alex Booth, who is the head of research at Kpler, the leading provider of data and analytics in commodity markets. And Alex also has experience with BP and Citi. And also we have Helima Croft, who is the head of global commodity strategy and Middle East and North Africa research at RBC Capital Markets. She is also a member of the National Petroleum Council, which includes a select group of individuals who advise and make recommendations to the Secretary of Energy in the US with respect to oil and gas markets. So welcome all. Let me start with Giovanni and ask you about prices. So we're seeing oil prices bouncing strongly, and many are expecting prices to hit $70, $75 quite soon. I mean, are we going to see these conditions prevailing and prices would go back? I think they're almost back to the pre-COVID levels, but how sustainable they are, and are we going to see even higher prices looking further down the line this year?
Thank you. Yes, prices are basically the same level that we had in the same period of the year in 2019, but those are prompt prices. If you look at the back-end prices, like 1 year, 2 year forward, they're still $6 below what they were in February 2019. What does that tell you is that what the market is pricing right now is the sustained strong short-term deficit in the market. There is the stock draws that have been happening since summer last year that have continued at a pace of 2 to 3 million barrels per day relentlessly, thanks to supply discipline and demand recovery. And the expectations that these stocks will effectively bring inventories to, the stock draws will bring inventories to pre-COVID level in the next few months. So it is largely a short-term driven price action that is, I think, well supported by fundamentals right now. Whether this is sustainable or not brings back the question on what will happen to the back end of the curve, that is to long-dated oil prices that right now are still cheap. They are still below the level that we had in 2019. And in order to kind of answer that question, then we have to ask how the kind of super cycle in oil will materialize relative to other commodities. So at this point right now, I think there is a very good point to make that oil will lag behind any other commodities in terms of structural support to oil prices, and that the further upside that you might have in prices right now is largely driven by the stock inventory profile in the next 2-3 months.
So Giovanni, just to clarify, so you think that oil will or will not join other commodity super cycle?
No, from a call it structural perspective. We think that effectively we are not seeing neither the market telling the oil market to invest, because the back end of the curve, long-dated oil prices are still fairly under pressure, nor are we seeing inflation in costs in the oil market emerging at this point right now. Those are the two characteristics that typically drive commodities through a super cycle. What we are seeing is a strong backwardation in the curve that is reflective of the steep stock draws that we are experiencing thanks to supply discipline and resilient and hopefully even more strongly recovering demand.
Indeed, I mean, I will come back definitely to the discussion about OPEC, but first, let me stay a little bit on the demand side and move on to Meghan. And what we saw last year, Meghan, until today, we saw how the pandemic has been driving the global economy and in turn has been affecting oil demand with, of course, repercussions on prices. But looking further ahead, what impact will the course of the pandemic have on oil markets going forward, or are we already seeing these two decoupling?
I would say you'd have to be really overly optimistic to believe these things are decoupling. I think one of the largest uncertainties looking at global economic growth projections is the course of the virus. And I think there's largely an expectation, a certain optimism that the world is beginning to see the light at the end of the tunnel of the pandemic with the rollout of vaccines. And I think that's reflected in the IMF, updating and increasing its expectation for global economic growth for 2021. But, as the IMF suggested, there are major uncertainties with these projections. And I think the more we see about what is happening with the pandemic, we have to acknowledge that there are some risks that are very real to a smooth move away from the transition. One of them, of course, is vaccine distribution, how equitable that is going to be. There's been several studies that have come out recently showing if the world does not vaccinate countries in an equitable manner, then this is going to be a big drag on global growth. And right now, I think there are big questions about whether the developing world is going to have access to the vaccines and anything like the pace of the developed world. There's also, I think, that the question about just how the developing world is going to emerge from this virus. It certainly doesn't have the same fiscal resources that the developed world has in terms of increasing domestic demand and drivers of growth domestically. As I mentioned, there's vaccine questions, and there's also some pretty serious concerns about debt crises emerging in some developing countries. And given that we expect global energy demand and global oil demand really to be fueled by a push from the developing world, these big uncertainties around the trajectory of economic growth, I think, are huge. The last thing I'd mention is simply that there's also an interesting question about to what extent is COVID going to accelerate the commitment to the energy transition. There are many people now trying to connect the pandemic to climate change. We see Bill Gates out with a book just this week saying climate change is going to make the pandemic look like child's play. And whether or not these perceptions are going to lead governments and others to increase their commitment and their policies to expediting the energy transition and bringing down global oil demand.
I like that you mentioned the issue of the developing world in particular. I mean, definitely around the world, everywhere you see governments, corporates, households, I mean, the amount of debt that has been accumulated is really frightening. But the difference with the developing world is the capacity to repay the debt and the cost. That said, there could be a silver lining because they don't really have massive easy money, and that could encourage some much needed reforms in these countries. So there could always be something positive to look at, but you're absolutely right about the level of uncertainty. Leila, let me turn to you with respect to a very important issue. Giovanni alluded to it in the previous session with the IEA. We also talked about the importance of investment. How do you compare the impact on investments due to COVID-19 compared to previous crises, and what are the implications for oil markets and the global economy in general?
Yeah, thanks, Carole. I think there are a lot of interesting things happening on the investment side. Usually people like to quote headline numbers, and I think when it comes to investments, 25 to 35% would be the range to keep in mind that is often quoted. I think there is a report, the IFBCG report has really indicated that oil and gas companies have cut their capex by 34% in 2020. I think that's slightly more than the 28% reduction that we saw following 2014, but it's definitely more than the 20 or 25% witnessed in the wider energy sector. And I know that Keisuke has talked a lot about the rest of the energy sector indeed. But I think for us, from an oil and gas perspective, it's important to remember that post-2014, investments were cut roughly 25% annually for 2 years in a row, for 2 consecutive years. So how long do we think the current downturn in oil and gas investments will last this time? Well, I mean, first, the industry pledged to invest around $300 billion in upstream oil and gas. That's flat compared to 2020 in 2021, but that's still the lowest in 15 years. And less than that, a third of that is in North America. So we can take the discussion on U.S. shale versus other major producers in the second half of this session. But I think this time, I personally think it might be different because the industry reached 2020 as a dramatically entrenched industry that was hit by 3 crises in 1 decade. And I think for the most part, the industry has been undervalued. So it's true that pre-crisis growth expectations were already modest and investors were generally being viewed as abandoning the sector. It's beyond the anecdotal ESG discourse, but I think it's mainly because the sector has provided the lowest returns to shareholders during the last decade by a wide margin. So I think what is quite interesting, in addition to the pricing volatility or the price curve changes that Giovanni has described, I think from the perception of the investors, it's quite important to see that the industry has witnessed at the end of 2020, early 2021, actually a return, a flow of investments by retail, index, and other institutional investors. So I think the picture would be mixed, and depending on what part of the value chain you're looking at, there will be some, I would say, losers, but also winners in the investment story going forward.
Yeah, it's interesting that indeed, actually, we forget that the crisis hit the industry. And I'm not talking only about the private oil and gas producer, but I'm also talking about countries, major oil producing countries, including in the MENA region, for instance, that the crisis hit them just at a time when they were still recovering from the effect of the 2014 collapse in price. And actually, if you look at the last 10 years of oil price, you can see that since 2014, actually prices haven't really recovered to the price levels that dominated the years before that. So you can see some countries, for instance, such as Saudi Arabia, Kuwait, the UAE, they entered this crisis with a weaker economic position than they faced, for example, the crisis in 2014. Let's now talk a little bit about these producers and the supply side. And I'm going to ask first Alex and then Helima. Alex, so aside from the shuttering demand growth, what are the supply side risks to a sustained recovery in oil prices throughout 2021? So we're going to be focused on the short term.
Yeah, sure. I think it follows on again from what Giovanni was mentioning, referencing the draws that we've seen, anything between 2 to 3 million barrels a day through since last summer. That's ultimately the same that we've seen in cuts from exports from just 3 countries: Saudi, Iraq, and UAE. That's in the kind of the 2.5, 2.6 million barrels a day mark versus March of last year. So that's kind of before the run-up in production that we saw in April, but then after the real cuts that we saw in the entry into the pandemic. If these countries bring back that 2.6 million barrels a day, we withdraw the draws. We can see kind of increases in other parts of the world. So these are just 3 countries which can bring back supply relatively easily if they want to. We're not even talking about the more tricky geographical areas, more tricky, whether it's from a geopolitical standpoint or from a technical standpoint. So I think that the situation that we're in is kind of cautiously optimistic on the supply side, where we can bring back a reasonable amount of supply relatively easily to meet these stock draws. And we're already at a point where, say, China is starting to build again. So we've started to see, after a steady period of draws through China, a turnaround in February. So that's ticking to the upside. Yes, they are still importing a lot of crude, but it's very, very uncertain kind of where we go from here, because that supply can come back very quickly without kind of any real hard work, I think.
Well, speaking of hard work, let me ask Helima about where she sees OPEC, perhaps something is happening actually next week, which is the March meeting for OPEC+. I mean, definitely they had a rough ride, but I have to admit that they have been pretty successful, not just at shoring prices up, but also as drawing down inventories in such a rapid way. But if you just maybe tell us a little bit about what we should expect perhaps from the meeting next week, and what is your biggest cause of concern with respect to OPEC and OPEC Plus in general?
Well, I think you're right, Kel. I think OPEC actually has done a remarkable job sort of holding together the coalition since they did the big supply, cut that we saw, in the spring. But I think some of the fault lines that we saw, that caused the sort of breakdown are still present. I mean, I do think we have, the Russians, they're eager to put more barrels on the market. We even saw, in December, you had, Alexander Novak, the Russian deputy prime minister, who still handles the OPEC portfolio for Russia, really saying in December, like, look, if we don't add more barrels to the market, somebody else will. And they have been more optimistic about the pace of the recovery. They've been more optimistic about the sort of adoption of the vaccines. And so I think they remain eager to put those barrels on and get back to the sort of tapering process. On the other hand, I think we have the Saudis sort of taking the Meghan O'Sullivan position, more concerned about, potential COVID variants, the slow pace of the vaccine, wanting a more sort of prudent course in terms of managing,
bringing supplies back onto the market. We saw the Saudis do that unilateral 1 million barrel a day cut that's going to expire, at the end of March. I think we are going to see them starting to bring barrels back. But I think what's very interesting, and I think this is where we've had some adaptation from the part of OPEC Plus, is because we are now having, monthly meetings as opposed to meeting every 6 months. I think they can course correct as needed. They can calibrate production policy in a way that they weren't doing before. And so I think that has been probably the biggest evolution in terms of how OPEC Plus is managing the market. So even if they start bringing supplies back on, I do think they have the ability now to course correct. And that was something that I had been concerned about, is once you start bringing supplies back on the market, does discipline sort of break down? Can you do it in a controlled way? Because we do have producers that really are struggling under the production cut. You have the issue of Iraq, and Iraq has the challenge of their budget. They have the problem of when they shut in production, associated gas is impacted. And so a country like Iraq is eager to bring barrels back. And so I've always been concerned about, once you start the process of bringing the barrels back, can it be done in a controlled way? But again, I think having the monthly meeting schedule does bring the ability to course correct and fine tune OPEC policy.
Actually, you mentioned Iraq and the issue of controlling supply back. I have the feeling that when you look at the market today, that the market seems to be dismissing the return of Iranian oil to the market, because as we know, Iran has been exempt from OPEC plus cuts. But it would be great if you can perhaps talk about what the new administration, the Biden administration, might do with respect to the Iran nuclear deal, what is known as the JCPOA, and if they reach an agreement, maybe by when in terms of timing, and how many barrels should we expect to hit the market, and what does that mean for OPEC plus and for the market. I know it's complicated, but I try to take us through in a concise way, just to understand whether we should really be concerned about the comeback of Iranian oil or not at least not this year.
That's a great question, Carol. And we're actually seeing the Iranian oil minister being invited to the JMMC discussions that OPEC is having. So I think OPEC is starting, or the OPEC management team is starting to think about the Iranian barrels potentially coming back. But I think it's going to be really determined based on what happens in the next couple of months. We have the Iranians taking the position that because the U.S. exited the agreement in 2018 and reimposed sanctions, that the U.S. must first remove sanctions before Iran becomes compliant again with JCPOA. And Iran in recent months has basically restarted their nuclear activities and has breached the agreement on several fronts, potentially in terms of what they're doing in terms of high-level uranium enrichment, or levels that could be closer to weapons-grade material. And so I do think it's going to be really important to see what happens, because we're going into the Iranian election season, and there is a view that once you get to spring, all of the work that you could be doing on the diplomatic front may slow down as the Iranian leadership starts to focus on those elections. So I do think it's going to be very important to see, can you get some type of interim agreement in the next couple of months that could potentially start bringing back more barrels in the back half of the year. I do think if you get to a situation where you don't get an interim agreement before the elections, then bringing back, 1 million barrels plus of Iranian crude onto the market could be something that could be pushed out further into the year or potentially into 2022. The only other thing I would add is we are seeing more Iranian volumes on the market. I think the Iranians have become more adept at circumventing sanctions. So I think it's going to be an interesting test for the Biden administration, how much they want to do to potentially try to, interdict some of those ships that are carrying that Iranian crude. I think that's going to be an interesting question about what's the U.S. resolve to really enforce these sanctions as we're in the diplomatic process.
There's a lot I'm going to ask you about when it comes to the Biden administration's energy policy and its implications on energy markets. We also have the next session covering that also in detail. But I want to bring into the discussion a very important player. They are important on the supply side, but we know them as a major consumer, that is China. And I will ask Meghan about how the events in China are likely to affect oil market in the year ahead, both domestically and internationally.
Great. Thank you, Carole. It's a really important question. We all know that what happens in China has major implications for energy markets and for the rest of the world. And I would say, just a note, you asked me about this year, but just on the long-term question, obviously there is the major issue of how robustly China embraces the energy transition, because that will decide in many respects not how much China moves away from a fossil fuel energy mix, but how much other countries will do at the same time, because China will be so influential in influencing the energy transitions of multiple countries. But since you asked about 2021, I would say there's a couple of things that are important to look at when we're trying to think about China's role in oil markets or influencing oil markets. The first thing, I think most importantly, is this question of Chinese economic growth. China was the only major economy to grow positively in 2020 in the realm of a little bit more than 2%. So obviously a lot less than it had been growing before, but certainly in a departure from the rest of the world. And now looking forward to 2021, the expectation is that China is going to continue to grow robustly. I think the projections are around 8%. But of course, as I've mentioned in the context of global economic growth, there are some pretty serious uncertainties about China's economic growth as well. There's less concern about the virus derailing China's economic growth and a little bit more concern about the debt burden that China has amassed over time and whether that will complicate things. On the whole, I feel pretty optimistic that China will be an engine of growth for the global economy, and that this will be good for energy demand as well. The other issue is one that Alex brought up, which is the question of what role is China going to play in bringing down or stabilizing or affecting global balances. Because in 2020, we saw that China played a massive role in shoring up its stockpiles when the prices of oil were so low. It's certainly not going to be stockpiling and building up its reserves anything like it did in 2020 in this coming year. So that will have an impact. Just where the country comes on that question, I think, will be consequential as well.
Thank you. Alex, speaking of these regional demand rebounds and sectoral rebounds, we still see really an uneven picture. How could that impact the crude and product markets?
Yeah, certainly. And I think if we start on the regional imbalance, first off, we have this huge split east versus west. You have large parts of the Eastern Hemisphere, Asia Pacific, Oceania, which it's not business as usual for sure, and that jet demand, as we've heard in earlier sessions, is not there, and the extent to which that will come back is very uncertain. But we are seeing good product demand across the Far East. In terms of sectors, LPG has been very interesting. I think we're tracking about the highest level of LPG imports into Japan through February at the moment. Very strong. That's okay. It's coming out of the heating season, but then it also feeds into the petrochemical demand sector. Across East Asia as a whole, petchem feedstocks are doing very well. We're already seeing growth in terms of imports into the region versus this time last year. And that was before we were already set to have a reasonably strong year for petchem demand before the pandemic hit, and then kind of PPE production took off. So that's continuing. So really, if you're looking at kind of where crude is going to be going, the flows through the course of kind of the rest of this year, the pull really is going to be in the east. Europe is still kind of the laggards here. The refinery runs are very depressed. The kind of crude imports into OECD Europe are depressed. There's increasing competition, say, now with new refinery capacity in the Middle East, putting ever further pressure on. And it's hard to see when you're kind of, maybe our view of demand is slightly tarnished, having been sat here in London for the last year, not being able to do anything or go anywhere. But the plans that are being set out for the recovery through the rest of the year is going to weigh on the region. There's a bit of respite with, say, the pull into the US out of Europe at the moment. That's kind of some very short-term specific impacts after the refinery shutdowns in Texas through the last week. And we'll see how that comes to play over the course of the next couple of weeks, because it's going to be a bit of a messy restart process, it seems, when you shut down that much capacity with that quickly. So there'll be a bit of a respite there, but otherwise just have to see how the virus progresses, vaccinations progress in the US, but we'll see them pick up before we pick up in Europe anyway.
So what you're saying also confirms that actually COVID may have derailed growth temporarily, but we are still expecting to see that the main growth engine for energy demand, and particularly for oil demand, will still be Asia, particularly China and India. Though interestingly, last week, the Indian energy minister, and it was for the first time I heard somebody already complaining about the rapid escalation in oil prices, because it can also weaken the economic recovery in those economies. So that's something to watch for, maybe less so in the developed economies where we saw decoupling getting more pronounced between the economy and oil. But in Asia, that is something also to watch for. Leila, I want to come back to you about the industry and ask you about what structural changes you are seeing when it comes to the oil and gas industry, consolidation, strategic responses, integration, and regionally, if you want, or the industry globally.
Yeah, I mean, thanks, Carole. I mean, that's, I think, an important question for I mean, looking at the short to medium term, but also even to the long term. I don't want to start talking about what will happen in 2040, 2050, but if we look at the next, I think, 10 to 15 years, there will be, and I think there's now an increasing consensus that we will have all the ingredients for more consolidations, indeed, more M&As, market share repositioning, particularly around those low-cost, low-carbon assets. So those ingredients are definitely there. And not only, I mean, people talk a lot about US shale and a lot of the consolidations that are happening there, but I think it's also relevant for the wider oil and gas sectors for different reasons, including the lack of cost inflation that Giovanni has mentioned early on. But also, building on the same argument, I think there's now a sort of $40 per barrel break-even price for any project today that several companies are having in mind. Vicky Holub, Occidental, has shared that last week. And it coincides basically, it's more or less the same ceiling that is being used today in the strategies of, I would say, large IOCs and also some large NOCs, which also have access to those low-cost, low-carbon assets. So I think from that perspective, there are a lot of things that are happening on the consolidation side. Generally, people talk about the investments of the IOCs in renewables, so they view that as a way to diversify their portfolios. But I think from the NOC side, they will indeed try to secure their market share as much as possible in what I call myself a plateauing pie, not a shrinking pie, but a plateau. And there will be in this new landscape fewer smaller companies. So I think that in the next 4 to 5 years, we will see less and less independence in that landscape. And I will bore you a little bit with some numbers. How does that landscape look like? I think there are two numbers to keep in mind. Before 2015, it was 250. And going forward, it's going to be 100. I'm talking about hydrocarbon-bearing basins in the world. There are about 500 to 600 hydrocarbon-bearing basins in the world with enough proven or potential hydrocarbons. Before 2015, you had approximately 250 of those basins, which were the site of at least one new wildcat well, so exploration drilling annually. That number has dropped to 160 basins after 2015. And what we've seen in 2020 with COVID-19 pandemic and also the accelerating energy transition is really pushing that number towards 100 going forward. So I think whether we believe that we are coming back to a $19 trillion economy, as Dan Yergin likes to put it in New Map, or moving to an aspiring $100 trillion economy, I think we will have to, oil and gas companies will have to play in that not shrinking, but plateauing market share. So from that perspective, there will be, I think, much more consolidations around those low cost but increasingly low carbon assets, because carbon will have to be priced whether we like it or not.
It's interesting what you said about the independence. You made me think of an interview one paper did with the CEO of an independent company, E&P company, and he said that they are holding on to this business because the IOCs of this world are moving more and more into a greener energy, and somebody has to produce the oil and gas to still meet the demand out there, because oil demand is not going to disappear overnight. And this is where they will take advantage of taking a piece of the share that the IOCs will leave behind. But Leila, I know we're not yet in the Q&A, but because what you said, there is a question that is directly related to what you said. I'd rather take it now. And it's from Stuart King, because he's asking whether the investment in oil and gas lower today because of oil price, or is it because the IOCs are also investing in other sectors such as renewables more than in the past? And then if you account for those investments in other areas, do you still get a lower figure of investment compared to 2014?
Yeah, I think that's a great question, but it's really looking into the wider energy sector indeed, and then the numbers become a bit more complicated to track. I think overall the headline number is indeed lower than 2014, but for different reasons. I mean, indeed you have the impact of oil and gas prices, but you also have the impact of lower cost inflation than 2014. I mean, remember at the time, the cost index, I think IHS was tracking cost indices in various parts of the value chain, including in utilities. And you remember that period where we were all seeing those costs ballooning in every part of the value chain. So I think part of it is indeed due to a lower amount of projects, and we see that definitely in LNG. I mean, last year, 2020 was a dry year for LNG. We had only one FID. I think it was 3 billion tons per annum of liquefaction capacity being sanctioned, being FID'd. Compared and 97 million tons per annum were being totally frozen. So you definitely have in selected parts of the value chain a lower number of projects and lower capacity because of lower oil and gas prices across the board. But at the same time, I think it's quite important to keep in mind the cost inflation aspect that makes some projects today, and also the consolidations that I was talking about and the higher integration in the oil and gas sector. So companies are just having to be much more going towards the lower part of the cost curve, all of them. So that makes indeed the overall investment figure lower than 2014.
Thank you, Giovanni. We're going to move on a little bit to the big theme of the energy transition. I know people talk about it and that COVID-19 has really accelerated the energy transition. But what does that mean for oil cycles?
Whether it has accelerated the energy transition is still to be seen. Meghan made the point very clear that are the government accelerating the investment on the energy transition after COVID or not? There is still a big question on how consumer behavior will change once the COVID emergency is over. So this, we will see whether it accelerates. But definitely, every commodity has always been subject to cycles, and the cycles come from the fact that the investment in this industry come in lumps. Because of economies of scale, you tend to invest in around 4 or 5 years for the next 15, 20 years. What is different this time around, and what is different in the oil cycle, if you want to put it, is that there is the energy transition. There is an expectation that oil demand will not accelerate. in the next 10 years. We don't think it will decline. We don't think that we have a peak demand in the next 10 years, but still it's unlikely to see an acceleration going forward. So that means that the market is not incentivizing investment. The back end of the curve is not going up. And we are likely going to see something that we have not seen often in the past. There is a scarcity in the short term of the commodity through a investment cycle. Typically, what happens in the investment cycle, think about 2004, 2005, is that the back end of the curve, the long-dated oil prices tend to go up to incentivize investments. You create inflation in cost structure for oil, and you might create situations where you have a little bit of an oversupply in the front of the curve. So contango was a quite normal environment in the previous investment cycle, in the super cycle. I think backwardation is going to be a pretty standard concept for this cycle, because it's not going to come through the support to prices is not going to come through investment in the industry, and demand will not drop significantly after COVID. So you still need to keep a level of supply high. You are going to have a lower level of inventories, potentially even more room for swing producers like OPEC to control the market because of this endemic lack of investment. So the big difference between this time and the previous cycle is that we are going to have a scarcity in the market until there is going to be a change in demand direction.
Interestingly, we were talking about the age of plenty before COVID hit, and now we seem to be moving to scarcity. But Giovanni, I'll stay with you because I want to pick one question from the participants, and I would like you and Alex also to comment on it. And that is, what are both the biggest risks and opportunities in the oil market for this year? Right. Giovanni, please go first.
Look, for this year, it is clear that the main focus is on demand. We do expect deck on deck, meaning December 20 to December 21, a 6 million barrels per day demand increase. And this is largely driven by the vaccination policies and so on and so forth. So we expect by year end demand to go back to the level that we had at the end of 2019. And interestingly, while we always talk about Asia and China as a driver of demand, almost all this demand is coming from the Western markets. The recovery is coming from Europe, that never really grows demand, and from the US. That is the part where demand was really capped. So the main risk is a delay in the recovery of demand. That is the number one, I would say. Then we touched on the supply side, and this largely is a call on Iranian sanction being lifted. I think that if the sanctions are lifted a little bit later in a few months, and if our demand call is right, you should have plenty of room to accommodate an increase in Iranian supply thanks to this big increase in demand. So I don't think it should be a big factor. The later it comes, the more space we have to accommodate that. And now the uncertainty coming from China, in my view, rather than being the demand outlook for China, which is always a number one driver of the market, but not this year because it's coming from the West, is whether China and the non-OECD markets, countries that have accumulated large amounts of oil and products during the low prices environment last year will decide to use those inventories and therefore push the deficit into pricing centers, or will decide to keep the inventories effectively there. So if they destock, you're going to have a little bit of a breather in terms of prices. But if instead they hold on to their stocks because they consider it important for the long-term security of supply, then you might have additional upside to backwardation in prices because the stock draws will materialize in pricing centers.
Alex, would you like to add something to this very comprehensive risk from Giovanni?
Yeah, I'd just say that I think Giovanni's covered all of the kind of the key areas there. But the best opportunity in any kind of trading environment is uncertainty, and I think that's the uncertainties that come through the rest of this year are what provide the opportunity. Essentially, it's going to be some great markets to trade in because there are so many unknowns. Everyone has a general idea of where things could be coming from, but the timings of all of this, I would say, are the key thing that's completely up in the air at the moment. And that's where that trading opportunity is for sure.
Meghan, I was going to ask actually this question, but then I can see that Sheetal Mistry from the Energy Institute did a fantastic job with her colleague organizing this event, is asking something similar. And it is about the future of geopolitics. What do you see that future as the energy transforms to a low carbon future? And I would add to that one question I prepared for you, what geopolitical events could have the largest impact on oil prices in the next year? So you have one question for the longer term and one for the shorter term.
Sure. Let me take the first question from Sheetal. It's a big question because there's so many dimensions to this. As we all know, energy and geopolitics are intimately tied. And when there's a big change in energy markets, then we should expect big changes in geopolitics. So I think the energy transition is going to ripple throughout the world. And it's not just when we get to a different kind of energy system or energy mix. It's the process that we will undergo in getting there. It's the actions that countries like the United States will take in order to try to get countries to decarbonize more. Joe Biden, the new president of the United States, has made it clear that decarbonization is going to be not just an internal domestic goal, but is going to be at the pillar of American foreign policy. So there are many relationships and countries we could look at. One that I would say is so consequential for the world of geopolitics is obviously the US-China relationship. So the question is, what impact is the energy transition going to have on this most critical bilateral relationship in the world? I think there's a lot of people, many of them coming into the Biden administration right now, that are optimistic that climate and the energy transition writ large can be an area of cooperation between the US and China. Certainly, we saw this under the Obama administration. Certainly, there are common interests that the US and China hold. And it's not, I think, a folly to believe this could be an area for cooperation. But I also see that as both the United States and China become more and more aggressive in their moves to decarbonize their economies and help other countries do it, I see it's going to become a realm of US-China competition. Already we're beginning to see it, but we see that the US and China will be competing for markets, for new energy technologies. They'll be competing for inputs that are required to build out new energy infrastructure and new energy sources. We also, we see that Chinese are very focused on this. I think the United States is just slowly waking up to the importance of setting standards in the new energy transition. The Chinese have really become very active in international organizations in setting new energy standards in a way that will basically bias the energy systems of different countries to Chinese suppliers. So again, I think the US is going to really become a lot more competitive in this realm under the Biden administration. And I do think that's going to bring some real geopolitical competition. We could also, we've touched on the Middle East, and we can go there if people would like to. But there, I think the impact of the energy transition and geopolitics is going to be different than conventional wisdom suggests. It's not just going to result in difficulties, it's also going to bring opportunities.
I like to hear this word more often, opportunities. I mean, I can feel lots of optimism in this panel, despite the high level of uncertainty that we all acknowledge. But let me stay a little bit with the Biden administration. And Helima, I turn to you because, again, we have, it's funny because I prepared these questions and we're getting also similar questions from the participants about the impact of the Biden administration more generally on energy markets.
Well, Meghan already touched on, I thought, brilliantly, and you're going to have Jason Bordoff. But, I think one of the really important things to think about is just how different the Biden approach is from the Trump administration approach. Like, I remember the conversation so early on in the Trump administration about American energy dominance. And that's the core foreign policy of the United States was often centered around energy, extracting the resource from the United States, putting the barrels on the water and having the ability to sanction countries like Iran and Venezuela and essentially pay no price at the pump for it. And we saw it sort of also meant the US didn't have to become engaged in places like they might have been previously. So I think what's going to be interesting is with the US trying to drive now the energy transition, and the whole conversation with the Biden administration is, how do you get to net zero by 2050? And what policies do you put in place? How does that potentially shape the sort of US energy foreign policy? So the Trump administration was very quick to call on OPEC when they wanted more barrels on the market, when we basically sanctioned Iran, when we were concerned about the price war and the impact on US producers. President Trump again made the call to Saudi Arabia, to Russia, to OPEC to essentially do the production cut. What I think is going to be interesting is I just don't believe that the Biden administration is going to be as focused on trying to manage the oil price. I think from their standpoint, they're going to focus much more on sort of global partnership around climate coordination. I just don't think it's going to be as engaged in terms of trying to either cap the upside in terms of prices or put in a floor in terms of prices. So I think that's going to be one of the most sort of interesting elements to look at is, you know, where does Biden engage in terms of oil producing countries?
But does this mean that there will be less importance for the Biden administration and less emphasis placed on what used to be the dream of American presidents, that is to become a net oil exporter? And what does that mean also the relationship between the US and, you know, you mentioned Saudi Arabia, for instance. Where do you see that going if oil is not really at the center of the energy policy and foreign policy of the US?
Well, I think the relationship between the US and Saudi Arabia, one of my good friends wrote this book, Rachel Bronson, it's called Thicker Than Oil. I do think that we've already seen the Biden administration talking about sort of recalibrating the relationship with Saudi Arabia. But that said, there's still very, very important security cooperation dynamics. So the US administration has come out and clearly stated that it's in the core US interest to protect the security of Saudi Arabia, you know, to deal with issues like the Houthi attacks on Saudi Arabia. I do think counterterrorism cooperation, you know, even climate cooperation, there are going to be whole areas where there's going to be still important cooperation with Saudi Arabia, even if the relationship isn't quite on the same standing as it was between, you know, the Trump administration and Saudi Arabia. But I think what's really interesting, Carol, when you talk about the issue of exports is something, you know, I think we could pivot a little bit to the issue almost of gas exports as well, because I think that was a really important foreign policy for the Obama administration, was to talk about how US natural gas exports helped the US foreign policy of potentially, you know, weakening Russia's control on European gas markets, achieving these Paris climate accords in terms of coal displacement. I think a remain to be seen item is what is going to be that sort of Biden approach to natural gas exports as well in the natural gas industry. But of course, that'll be a conversation for Jason Bordoff as well.
I won't have enough time to cover the US new energy policy, but I think you already gave us a kind of flavor of how energy policy and geopolitics and broader security interests and cooperation, they are all so closely intertwined, and we cannot really look at them separately from each other. Leila, there is a question about the supply chain protectionism, and how do you see that impacting energy markets? Is from Will Sadler.
Right, I think it's I mean, it's an interesting question because it comes right after 2020, where, if you remember, Carole, we discovered a world that is much more interdependent than before, and we just discovered it. And also, I think in the industry, we discovered an industry that is very, very interdependent. We discovered the restrictions to projects and supply chain. So, for example, I think the example that I always give is the LNG and the business and shipping business depend on Asian shipyards. So if Asia was the first one to be hit by COVID-19, there you go. It's a whole part of the industry that is quite dependent on that. Oil and gas field services actually, whether you are an NOC or an IOC or even independent, actually equally depends on specialized engineering in Lombardy, Italy. There you go. These are all regions that were hardly hit by the first waves of COVID-19. So the industry woke up to we already knew that we were quite dependent on specific regions, but it was quite important to see the synchronization of those regions being hit all at the same time. In China, I think there was a discussion about China early on by Meghan. With its manufacturing capacity, I think it's equivalent to that of the next 13 emerging markets. So it will definitely not be easy to replace, including when it comes to low-cost manufacturing and for energy technologies. I think these are all bringing, of course, pressures in specific parts of the value chain to decentralize and to localize. And I think this pressure has been exacerbated by the COVID-19 pandemic indeed. So you have, if I take the example of Saudi Arabia, it was already quite optimistic to localize through its ICTIVA program, which is the in-kingdom total value added program, but it is definitely a way now to accelerate these oil and gas industry localization programs wherever it's possible. So I think you will see going forward much more and more attempts actually to decentralize and to localize as much as possible because of what we've seen today. And it's also getting back to the cost inflation. If you can make sure that you do that without increasing your costs, that's even better.
I would love to discuss this further, but we still have 5 minutes left. And before I ask you to maybe tell us each of you give us one key highlight of the discussion, perhaps I'm going to take one last question, but ask you very briefly, because the question is about if there's any consensus, and I'm going to take it as consensus among the panelists, because out there is no consensus for sure about when we are going to meet peak oil demand. So if I go around my speakers, Giovanni, with you first, what do you think?
We don't think it's gonna happen in the next 10 years. And I don't think there is a big consensus. The two main uncertainties are impact of COVID. So it's gonna be a long-lasting impact. Typically, when people have called for peak oil demand earlier, is because either they believe that COVID will last longer, or because they believe that COVID will make a gigantic change in consumer behavior. I don't think any of the two will be very meaningful to derail growth in the next 10 years.
Leila, I'm going through, who I see by order on my screen. So, Leila.
All right. I mean, my answer will be actually slightly different to the question, because I think you will have actually much more years on when peak demand will come, simply because I think the main impact of this crisis is that energy demand will start being modeled totally differently, because you will have long-term unemployment in affected sectors, you will have bankruptcies, you have deep restructuring of several sectors all at the same time, and the recovery will not be synchronized between those countries, like in the US, mobilizing the largest stimulus plan since the Great Depression, and those countries that are on the verge of becoming failed states. So I think what we used to do as energy modelers to model demand is going to be totally different going forward. And even the way we calculate the call on OPEC crude will also be very different. So I think I'm afraid you will end up with actually less consensus than before going forward.
Helima.
I mean, I think one of the big issues is going to be what can be done on the policy front. I mean, I think that's the kind of question about sort of when we can reach peak demand. And one of the things that I'm watching for is, what has happened in Texas? Has that sort of changed the dynamics on Capitol Hill about pushing through things like tax breaks for wind and solar? Now that you have more sort of questions about sort of what happened with wind turbines in Texas, like, is that going to sort of potentially mean that you can't get bipartisan consensus on some of these key issues that we thought potentially was going to be there? So I think it's going to be sort of policy dependent going forward.
Thank you, Alex.
I think kind of touching on the other end of the spectrum on the consumer scale, it's kind of the shifts that are needed to move out of the kind of the oil-focused market, out of the oil-focused existence. It's going to be very slow at the consumer level as well, and that's the changes in consumer trends, if we look at electric vehicles and so on, even, yes, there is great growth, but the market penetration at this point in time is still so low in the vast majority of the world that it's going to take a very long time for that to work through. So again, I can't see us hitting peak demand anytime soon.
Meghan, are you going to be as diplomatic as your co-speakers?
Yes, I feel that the previous three speakers have cleared the way for answering the question in a different way. And I do think, this was a hard question to answer a year ago. It is a much harder question to answer today, given all of the things that we discussed. I'd really just like to underscore something that Helima said, which is about, what is the policy landscape going to look like? Unlike other energy transitions in the past, this energy transition will be dependent on policy drivers. And I really do think 2021 will tell us a lot more. I think if we gather a year from now, we will have a much clearer sense of whether this moment that we're in right now really is an inflection point for how the world addresses climate change and how the world is pushing for it. I think there's certainly a sense here in the United States that we well could be at an inflection point in how the U.S. engages on this. And certainly we're looking to COP26 at the end of this year, and that will be really revealing. This is the time in which countries were supposed to come to the table with much more energized and aggressive plans to decarbonize their economies. We'll get a sense whether the world is really serious about moving forward in a way that we're going to see policies rather than just rhetoric. So I think this year will be consequential and hopefully help us give you better answers next year.
Yeah, I hope so, though I doubt, because what you all confirm, and I'm going to take your remarks on the peak demand as concluding remarks because we're at the end of the session. But if I were to summarize your answers, I would say nobody really knows when demand actually peaks, because it's much more complicated than really just saying it will reach a peak on, let's say, on certain day, 2030 or 2035. There are so many assumptions based on that. And I love Leila's point about the need to revisit our conventional models and think about a different way when we look forward in terms of our forecast. Thank you very much, Giovanni, Leila, Helima, Alex, Meghan. I can go on and on talking about all these core issues, but hopefully, I see you again on different occasions, and I'll keep on following your work. This concludes our session on the recovery in oil markets. I am leaving more with a sense more optimistic, although the level of uncertainty is still high, quite understandably, but there seems to be an optimistic beat, although in the longer term, there are perhaps more question marks. We're going to have 5 minutes break, so 5 minutes break only, and please join us again at 4 o'clock UK time to look at, to have a deep dive with Jason Bordoff on the Biden administration's energy policy. You can join us back at the auditorium, accessed via the lobby or the menu on the top of your screen. So I'll see you back in 5 minutes, and thank you very much for the speakers to join us. And excellent job, the Energy Institute, for having such a high number of female speakers. And it was something that one of the participants highlighted to discuss such a timely issue. Thank you very much.